It's Brian Preston, the Money Guy.
All right, this next question is from Kirk. Kirk said, I love this one. Hey, do you have any guidelines for buying a first home? I'm debt-free, have about 5 to 6 months of emergency reserves. I'm saving 25% of my income for retirement, and I recently started saving for a down payment. So he's like checking all the boxes. Man. His question is, when it comes to a first home, what are the things that make that unique, or what are some things I should think about as I approach my very first-time home purchase?
Yeah, I mean, there's multiple components here. There's the enjoyment factor, and then there's the analytical number side of this. At first, Kirk, I don't know, you didn't tell us if you're single, if you're married. Don't go buy the big honking house that you think you're going to raise the kids if you're not even married and haven't found that significant other, because more than likely that person is going to have an opinion as well. So it's better to have some flexibility. Now, if you do have your significant other already and y'all are on the same page with it, we can position to from the why, after you look at career, are we going to be here for the 5 to 7 years that we need to? Is my significant other going to appreciate or like this decision of where we are? Does this fit into the schools if we decide we're going to have kids and so forth? All that will come into shaping what your picture and what your why looks like. And once you figure out the yes, let's move forward versus no, and where the spectrum is, you can then kind of move to the analytical side of this is. And I know this is hard on the coast, and a lot of you guys will throw rocks at it, but I'm always like, look, if you can't make this work within the guidelines we're telling you, you got to squeeze somewhere else, but don't hurt your future savings and your retirement savings and your wealth building. You just a lot's going to fall on you. But I like to keep housing below 25% of your gross income. I know that is an aggressive number because the basic debt indicator is around 28%.
When you say keep housing, you mean like the monthly service on your housing?
Principal, interest, taxes, and insurance. And if you want to get squirrely and really aggressive, you can do utilities, but I'm not going to push the utilities on people. But you need to be thinking about how much housing costs, because I think it is the biggest expense that people have. And I just don't want to see you go take down a house that is now 50 to 60% of your life, because you'll find that your house rich and life poor, because then you put on top of that your income taxes, you put on top of that your retirement savings. You're going to find out, and I don't even know what debt obligations, because what if you have student loan debt and other things sitting out there? You might find you just can't make it all work. So you kind of have to back into the mathematics of the situation, but first go through where you are in life, what the goals are, what lines up on, is this the right decision? Then transition over to the analytical calculation to make sure you know where the guardrails are, so that you do get that great big beautiful tomorrow of saving for the future, so you get all the things. I think, Kirk, somebody like you who's obviously going through like a financial order of operations type checklist, because you mentioned you're already saving this amount, you already have this much in cash reserves, you're doing all the right things, you're very methodical, you're very disciplined. This is going to work out well to create a process to answer the question.
Now, one of the big things that we always give, and I think it's a big relief, because I don't know that a lot of people in the financial industry espouse this, but you always hear 20% for down payment, 20% for down payment, 20% for down payment. And that's great. We do like for you to put 20% down on a home when you buy a home. However, for a lot of young folks, like you said, especially on the coast, it's a really difficult thing to get to 20%. In Nashville, if you're trying to get to 20% now, by the time you get there, the houses have already risen and you don't have 20% anymore.
It literally can run away from you.
That's exactly right.
So that is so... I mean, that's got to break you to some degree, that you need to have a system that's flexible so that you can actually get on the home ownership train.
So we think that if you are someone who's buying your very first home ever, don't feel like you have to chase that 20% number. It's okay so long as you still fall within that 25% of total income threshold for your service. It's okay if you only put 3, 5, 10% down on that first house. Now, that's only on your first house. If you decide you want to level up, if you decide you want to upgrade or move to your second home, well, then you got to do the 20%. But to get into that first home, assuming everything else lines up and everything else makes sense, Don't try to kill yourself trying to get to 20% when perhaps 3, 5, 10% will do the job, and it'll let you go ahead and get on the side of home ownership.